So if you're prepping for a meeting on retail trends, or you're just insanely curious about what happens when massive department stores go bankrupt, you are definitely in the right place today.
Yeah, absolutely. Welcome to the deep dive.
Because, for the better part of the last decade, Wall Street has just been writing these really colorful obituaries for the American shopping mall.
Oh, completely. The narrative is always that the mall is dead.
Right. Killed by e-commerce, crushed by Amazon. But we're looking at an environment where one real estate giant just casually signed leases equivalent to like 170 Manhattan City blocks in a single year.
It's staggering. It really defies all the conventional wisdom you hear.
It totally does. And that's our mission for this deep dive. We are taking a very dense, pretty jargon-heavy source, the Simon Property Group Q4 2025 earnings conference call, and we're translating it. We want to show you the hidden mechanics of American retail and real estate strategy.
Because when a real estate investment trust of this magnitude speaks, they give us a really granular look at the consumer. It's not just about buildings.
No, it's about consumer spending. It's a diagnostic tool. So before we get into the wild stories of like massive bankruptcies and what was the quote? Pissed off Canadians.
The pissed off Canadians. We will definitely get to that.
We'll get there. But let's lay the groundwork first with the headline numbers. And as data forward investors, we need to look at the math. They reported a record real estate funds from operation, or FFO, of $4.8 billion for 2025.
Right, $4.8 billion. And for anyone holding the stock or considering it, FFO is the lifeblood metric.
Let's actually unpack that for a second, because if you're looking at a normal tech company, you look at net income, right? But for real estate, you use FFO. Why is that?
Well, because of depreciation. Real estate accounting forces you to depreciate the value of your buildings over time, which, makes your net income look artificially low.
Because it assumes the building is losing value like a factory machine or something.
Exactly. But prime real estate usually appreciates. So funds from operation adds that depreciation back in. It's a much truer measure of the actual cash flow.
Okay, that makes sense. So $4.8 billion in actual cash flow. And then there's the domestic property net operating income, the NOI. That grew by 4.8% in the fourth quarter and 4.4% for the full year.
And what's fascinating here is how those numbers just completely defy the whole retail apocalypse story.
Yeah, because 4.8% growth might not sound like, earth-shattering tech multiples.
No, but you have to apply that to a massive portfolio. NOI is basically your revenue from rent minus your operating expenses.
Right.
So growing NOI by nearly 5% in an environment where inflation and labor costs are high, it means they have incredible pricing power.
They are passing the costs on to the tenants.
Yes. The rent escalations are outpacing the cost of running the malls.
Which brings me to the number that honestly just stopped me in my tracks, the occupancy rates. They are sitting at a 96.4% occupancy rate for their malls and premium outlets.
It's incredibly high.
And wait, it gets crazier. For the segment they called the mills, the occupancy is at 99.2%.
Yeah, 99.2.
Okay, let's unpack this. If e-commerce is eating the world, how are these physical spaces 96 or 99% full? It's like finding out flip phones are secretly the hottest tech on the market. How is that possible?
It's a great analogy. But, achieving 99.2% occupancy doesn't happen by accident. It's virtually zero frictional vacancy. If someone moves out, the space is instantly filled.
But how?
Because they fundamentally changed the tenant mix. The Mills properties are a perfect example. They aren't just selling clothes anymore. They tilt heavily toward value retail, outlets, and massive experiential and entertainment spaces.
Like what? What's an experiential space in a mall?
Massive dining pavilions, high-end movie theaters, indoor amusement parks. They are engineering destination assets.
Right, so you don't just go there to buy a pair of jeans and leave.
Exactly. You go for the day. It increases dwell time, which directly increases the money spent at the actual retail stores.
And the data backs that up. Total retailer sales, like the actual dollars going to the cash registers, hit $799 per square foot.
That's a staggering density of commerce, nearly $800 a square foot.
And it grew, right, like 4% in the fourth quarter and 3% for the year.
Right. And if the tenants are highly profitable, Simon Property Group has the leverage to raise the base rent, which they did. Average new rents hit $65 per square foot.
Because for the brands, a physical storefront in a crowded mall is basically a customer acquisition tool.
A very cheap one compared to digital ads right now.
Yeah, Facebook ad costs are through the roof. Okay, so they have 96% occupancy. The buildings are full. But that creates a ceiling, right?
It does. You can't lease space you don't have.
So what do they do with that $4.8 billion in cash? They go on a shopping spree. In 2025, they deployed $2 billion into prime properties.
They went on offense while everyone else was struggling.
Yeah, let's look at the list. They bought the mall, which is such an arrogant name for a property, but I love it, and 2 luxury Italian outlets.
Which signals a huge belief in global luxury tourism.
Totally. And domestically, they bought a stake in Miami's Brickell City Center. They took the rest of Taubman Realty Group and Phillips Place in Charlotte.
If we connect this to the bigger picture, you can really see the Sunbelt migration strategy here. Miami and Charlotte are absorbing massive wealth and corporate relocations.
They are buying where the GDP is growing fastest, and they leased out 17 million square feet.
The volume is just wild.
To put that in perspective for you, 17 million square feet is like leasing out hundreds of Manhattan city blocks in a single year. It shows monumental tenant demand.
But the truly masterful part is how they funded it. This is where you see the power of capital allocation.
Oh, the debt. We have to talk about the debt.
We do, because they secured $1.5 billion in U.S. senior notes.
At what rate? Say the rate, because it's absurd.
An average coupon rate of 1.77%.
Wait, 1.77% in 2025, when regular mortgage rates are?
Significantly higher than that, yes. And they locked it in for an average term of almost 8 years.
How does a corporation borrow $1.5 billion at sub 2%?
It's all about perceived default risk. Simon has an A-rated balance sheet. Institutional investors want safety, and Simon's cash flow is so predictable that investors will accept a 1.77% yield just to keep their money safe.
That is just a massive financial cheat code.
It really is.
Yeah.
Especially when you consider their development yield. The COO mentioned their blended yield on new projects is around 9%.
So they borrow at 1.77% and deploy it into projects that pay 9%.
Exactly. They are generating massive shareholder value just playing that spread. They're playing monopoly while other regional operators are terrified of refinancing.
But, and this is a big but, what happens when the tenants actually fail? Because they can't control everything.
Yeah.
Which brings us to, honestly, the most counterintuitive part of this entire earnings call, the bankruptcies.
The anchor box shakeup.
Right. So during the Q&A, the CEO, David Simon, is talking about Saks Global. And he just casually mentions that they wrote off a $100 million investment in Saks Global at the end of the fourth quarter.
$100 million. Just gone.
Poof. Vaporized. And here's where it gets really interesting. Because my initial read as an investor would be, panic. You lose $100 million on your biggest anchor tenant. That's a disaster.
Any normal company would be slashing guidance.
Exactly. But David Simon was practically taking a victory lap on the call. He thought they were ahead of the game. So I have to ask you, wait, they lost $100 million and they think they won? Isn't relying on the demise of your biggest store a massive risk?
It sounds like it, right. But to understand why it's a win, we have to talk about the history of mall real estate. Back in the 80s and 90s, when these malls were built, the developers desperately needed Sears, Macy's, Saks, Neiman Marcus.
To bring in the foot traffic.
Exactly. The anchors had all the leverage, so they paid almost nothing in rent. On the call, they noted that Saks was paying something like $18 million across the entire portfolio.
Which is nothing for that amount of square footage.
It's a rounding error. But worse than the cheap rent were the RDAs, the restrictive development agreements.
Okay, yes, the RDAs. Explain these, because they came up constantly in the transcript.
Basically, an RDA gave the department store veto power over what the landlord could do with the property. The store wanted to ensure they always had, an ocean of parking right in front of their doors.
Right.
So if Simon Property Group wanted to build luxury apartments in the parking lot or add a new dining wing, Saks or Macy's could just say no.
They were holding the real estate hostage.
Precisely. So when Simon invested that $100 million in Saks Global, they put in contingencies. When the investment failed, they triggered those contingencies.
But what did they actually get for their $100 million?
They got 2 physical buildings back. They gained the right to terminate 2 specific leases. But most importantly, they permanently freed themselves from those restricted development agreements across the Saks and Neiman portfolio.
Oh, wow. So they basically bought their freedom.
They unlocked billions in trapped real estate value. They can now build out parcels, hotels, apartments, whatever they want, without asking permission.
But they still have this massive, empty, windowless concrete box where Saks used to be. How does that make them money?
This is the financial arbitrage. They take that massive box, they chop it up, and they lease it to modern, highly productive tenants.
Right. David Simon gave the projection The old Saks footprint was paying $18 million. By reclaiming just half of that space and putting in new tenants, they project making $30 million.
Nearly double the revenue, using only half the space.
It's brilliant. Oh, and they also got IP rights via Authentic Brands Group, right?
Yeah, for the Saks, Neiman, and Bergdorf brands. So if those brands make licensing revenue globally, Simon gets a cut.
Okay, but it takes serious execution to turn an old department store into a space that generates $30 million. You can't just throw up drywall. What are they actually putting in these boxes?
The transcript gave a perfect case study for this. Southdale Center in Minnesota.
Oh, yeah. David Simon said a few years ago that mall was basically a C or F grade property.
Yeah.
It was dying.
Right. They had massive vacancies from Herberger's and JCPenney. So they reclaimed that space, and instead of finding another clothing store, they brought in a massive Lifetime fitness resort.
Wait, a gym?
A luxury fitness resort. We're talking pools, cafes, co-working spaces.
That completely changes the foot traffic. You only go to a department store on the weekend, but you go to the gym 4 days a week.
Exactly. It creates daily, recurring, high-income traffic. They combine that with about 70,000 square feet of high-end specialty leasing. Now, Southdale is an A-tier mall again.
House of Sports was another one they mentioned, right?
Yeah, massive sporting goods experiences. So they are literally turning bankruptcies into gold.
So as an investor, if you see a legacy anchor tenant fail, it's actually a bullish signal for the REIT's future yield?
In the long run, yes. It's their inventory pipeline for redevelopment.
But, they don't operate in a vacuum. As we look at the forward guidance for 2026, management was pretty cautious about some major macroeconomic headwinds, things outside their control.
And we need to be very precise here. The CEO spent a lot of time on the earnings call talking about international trade policy.
Yes, and as a quick reminder for you listening, we enforce a strict impartiality rule here. We are purely neutrally reporting the CDO's business perspective on trade policy as it was presented in the call.
Right. We are not endorsing or criticizing the politics of tariffs. We are analyzing them strictly as a financial variable that affects tenant credit and bad debt.
Exactly. So purely from a financial mechanics standpoint, David Simon explicitly called out tariffs as a severe headwind for 2026.
He argued the tariffs uniquely punish smaller retailers.
How so? Why doesn't it hurt Walmart the same way?
Because massive conglomerates, your Costco's, Amazon's, Walmart's, they have incredible balance sheets. They have diverse supply chains. They can strong-arm their suppliers or absorb the shock.
But the specialty apparel brand in the middle of the mall can't do that.
No. If a mid-sized boutique faces a sudden 20% spike in their cost of goods, they have a brutal choice. Do they raise prices and lose customers? Or do they keep prices flat and destroy their profit margins?
And the CEO said tariffs could wipe out hundreds of millions in retail EBITDA.
Which directly impacts Simon. Because if those specialty tenants lose their margins, they can't pay their rent. It accelerates the risk of defaults across hundreds of small stores, which is much harder to manage than one big anchor box.
Yeah, that's a ton of frictional vacancy. And during the call, they even checked Polymarket, like the prediction market site, to see the odds of an injunction against the tariffs.
It just shows how closely commercial real estate is tethered to federal trade policy.
And it wasn't just global supply chains. They talked about regional anomalies too, particularly at the borders.
The border sales divergence was really interesting.
Yeah, so southern border retail bounced back, but the northern border slumped. And the CEO's exact words were, Canadians are really pissed off, so they aren't traveling to the U.S. to shop.
Which is a real problem for premium outlets in places like Buffalo or Seattle. Those properties rely on Canadians crossing the border for tax arbitrage or access to brands they can't get at home.
Right. So if geopolitical friction or currency issues keep that demographic home, sales per square foot drop immediately.
So these macro pressures act as a massive stress test for Simon's tenants.
So how are they fighting back? To combat these headwinds, they are pivoting hard into two specific areas that are pretty immune to inflation: luxury consumers and high-tech loyalty programs.
Let's start with the tech side. They launched a loyalty program called Simon Plus.
Which is fascinating to me. They are basically acting like a tech company. They are trying to gamify physical shopping to gather data and increase user retention, just like an app.
Because historically, mall operators have a massive data blind spot.
Right, because if I buy a shirt at Gap and then an iPad at Apple, those are two totally separate point-of-sale systems. Simon has no idea what I bought.
Exactly. Simon Plus bridges that gap. They use receipt scanning, app tracking, and rewards to incentivize you to consolidate your spending at their properties.
You unlock better parking or VIP dining if you spend enough.
It creates behavioral stickiness. It's a digital moat around physical real estate.
But the other moat is luxury. And honestly, the luxury sector right now is a mixed bag. Brands like LVMH are showing real caution globally.
There is a lot of market anxiety about a luxury slowdown.
But Simon is still aggressively opening top-tier boutiques like the new Chanel store in Boca Raton.
This raises an important question, right? How does a mall survive if luxury slows down?
Especially if they're leaning so hard into it.
Well, David Simon addressed this directly. First, luxury makes up a very small percentage of their total square footage. In their pipeline of leases signed but not opened, luxury is well under half. And that entire pipeline is only 2.1% of their portfolio.
Wait, really? Only 2.1%?
Yeah. But luxury matters because of the halo effect. A brand like Chanel doesn't take up 100,000 square feet. They take a small, highly efficient space. But having them there signals to every other retailer that this is an elite property.
It attracts the aspirational consumer who is generally immune to minor inflation.
And if luxury does pull back, Simon is protected by their massive diversification. They aren't just ultra-luxury. They have the value-driven mills, the premium outlets, and highly productive Class B regional malls.
He mentioned a property in Midland, Texas, right? Managing an asset tied to the oil industry while simultaneously building a luxury outlet in Indonesia.
That lack of homogeneity is their shock absorber.
So combining the record cash flow, the $2 billion acquisition spree, the alchemy of the anchor box redevelopments, and these macro headwinds from tariffs. What does management actually predict for 2026?
The guidance is where Wall Street makes its decisions.
Right. Let's look at the actual numbers. 2026 FFO guidance is set at $13 to $13.25 per share.
And they expect at least 3% domestic NOI growth.
Plus an additional $30 million in NOI coming specifically from those newly completed redevelopment projects we talked about.
But the psychology behind this guidance is what's really telling.
Yeah, and analysts tried to pin them down on their macro assumptions.
And the CFO admitted that their internal budgeting, which they finalized in mid-December, is deeply conservative.
David Simon explicitly said they budget retail sales to be flat-ish.
Think about what that means. If they are modeling zero growth in consumer spending, and yet they achieved 3% growth last year.
Then that $13 FFO guidance is a massively fortified floor.
Exactly. They have already baked in the tariff margin compression and elevated tenant bankruptcies into their model. So if the consumer spends even a little bit more than flat, Simon will blow past their own guidance.
And you could hear the confidence. Bankruptcies happened in early January that weren't in their December budget, but they didn't even flinch. Their leasing demand is so high, they can just backfill those spots instantly.
So what does this all mean for the listener?
Yeah, let's bring it home. If you are holding the stock, considering an investment, or you're just trying to understand the health of the American consumer, what is the ultimate bottom line here?
The signal is incredibly bullish for premium real estate operators. Simon is using its massive scale and cheap debt to outrun the economic headwinds.
They're proving that physical retail isn't dead at all. It's just evolving into a premium mixed-use experience.
They aren't passive landlords. They are actively dictating the physical retail environment.
So just to recap our journey today, we looked at Wall Street FFO numbers that showed massive pricing power. We tracked a $2 billion strategic acquisition spree. We learned how they used the bankruptcies of legacy anchors like Saks to break restrictive covenants and double their rent.
And we navigated the incredibly complex geopolitical dynamics of tariffs and border friction.
Yeah, it's a complete recalibration of how we view these spaces. And I want to leave you with a final thought to mull over. If a corporate landlord can write off a $100 million anchor tenant, chop up the building, and actually make more money by leasing it to a luxury gym or a high-end restaurant, then the definition of a mall has completely changed.
The real estate has officially outlived the retail brands that originally built it.
Exactly. If the physical footprint outlives the concepts inside it, what will our communities look like in 2050? Will we even call them malls anymore, or just enclosed, hyper-curated micro-cities? Simon Property Group is already laying the concrete for that exact future. Thank you for joining us on this deep dive, and we will see you next time.